In May 2018, Warren Buffett walked onto the stage at Berkshire Hathaway's annual shareholder meeting in Omaha, Nebraska, and did something he rarely does. He admitted he was wrong, not just a little wrong, catastrophically wrong. He'd missed one of the greatest investment opportunities in history, a company he'd studied, a company he'd admired, a company that was right in front of him for over 2 decades, Amazon. If he'd invested just 1% of Berkshire Hathaway's capital in Amazon in 2002, when the stock was trading at $15 after surviving the dot-com crash, that stake would be worth over $90 billion today. $90 billion from a $400 million investment, and he didn't invest a single penny. Not because he didn't understand the business, not because he couldn't afford it, but because of a mental framework he spent 50 years building. A framework that had made him the greatest investor in history had suddenly become the very thing that blinded him to the future. And here's what almost nobody talks about. This wasn't just about missing Amazon. It was about a systematic blind spot that cost Berkshire Hathaway hundreds of billions in potential returns across an entire generation of technology companies. Google, Microsoft, Netflix, Tesla, the list goes on. And the reason why matters more than the dollar amount, because it reveals something fundamental about success and failure, about wisdom and stubbornness, about knowing when the rules that made you great no longer apply. Warren Buffett is arguably the most successful investor who ever lived. He turned an initial investment of $10,000 into a fortune worth over $100 billion. He did this not through luck or insider trading or complicated financial engineering, but through a deceptively simple strategy: buy great companies at fair prices and hold them forever. He called it value investing. Find businesses with strong competitive advantages, competent management, and predictable earnings. Buy them when the market undervalues them. Then sit back and let compound interest work its magic. It's a strategy he learned from his mentor Benjamin Graham at Columbia Business School in the 1950s, and it worked spectacularly well for 60 years. Let's look at some specific examples because the numbers are staggering. In late 1963, American Express was hit by the massive salad oil scandal involving fraudulent collateral for loans. The stock crashed from $65 to $35. Everyone was panicking. Buffett spent weeks doing research. He went to American Express offices and watched people using their cards. He went to restaurants and saw that customers still wanted to pay with American Express. The scandal hadn't damaged the core business, so in early 1964 he started buying heavily. By the middle of that year, American Express was his largest holding. Over the next few decades, that investment returned over 100 times his money. In 1988, he bought $700 million worth of Coca-Cola stock. At the time, people thought he was crazy. Coca-Cola had been around for a century. How much growth was left? Buffett saw something different. He saw a global brand with pricing power selling a product with addictive qualities and profit margins over 50%. That investment is now worth over $25 billion, a 35-fold return over 35 years. In 1965, Buffett bought control of Berkshire Hathaway itself for $19 a share. It was a failing textile company. Most people thought he'd made a terrible mistake. He turned it into an investment vehicle and used the cash flow to buy insurance companies. Insurance became his secret weapon because insurance companies collect premiums up front and pay claims later. That gap, called float, gives you free money to invest. Buffett used Berkshire's insurance float to buy more companies, which generated more cash to buy more insurance companies. It became a compounding machine. Today, Berkshire Hathaway stock trades at over $600,000 per share. If you bought one share in 1965 for $19 and held it, you'd have over $600,000 today. That's a return of more than 30,000 times your money. He bought Nebraska Furniture Mart from Rose Blumkin for $60 million based on a handshake. No audit, no due diligence. He trusted her and she built an incredible business. He bought See's Candies for $25 million in 1972. It was generating $2 million in annual profit. Today it generates over $80 million a year and has kicked off over $2 billion in cumulative profits that Buffett reinvested into other businesses. These weren't sexy investments. They were boring businesses run by competent people selling products. That didn't change much, but they compounded relentlessly, and Buffett became a billionaire, then one of the richest men in the world, all while living in the same modest house in Omaha he'd bought in 1958 for $31,500. His annual letters to shareholders became must-read documents on Wall Street. His folksy wisdom, delivered in simple language anyone could understand, made him a celebrity. He was the Oracle of Omaha, the sage of Wall Street, the grandfather figure who proved you didn't need to be a slick trader or mathematical genius to get rich in the stock market. You just needed patience, discipline, and common sense. Investors hung on his every word. When Buffett bought a stock, the market noticed. When he sold, the market panicked. He was so successful, so consistent, so seemingly infallible that people assumed whatever Warren Buffett said about investing must be true. And for decades, he had a very clear message about what kind of companies to avoid. Technology companies. In the late 1990s, during the dot-com bubble, Buffett watched in amazement as investors poured money into internet startups with no profits, no revenue, sometimes no actual product. Companies were going public at billion-dollar valuations based on nothing but a website and a dream. Stock prices were going parabolic, everyone was getting rich, and Warren Buffett sat it out. He didn't buy a single internet stock. When people criticized him when they said he was old-fashioned and didn't understand the new economy, he shrugged. He said he only invested in businesses he understood, and he didn't understand technology. He couldn't predict which internet companies would still be around in 10 years, so he wouldn't invest in any of them. This wasn't arrogance, it was discipline. It was sticking to his principles even when everyone else was making money doing the opposite. And he was right, the dot-com bubble burst in 2000. Trillions of dollars in market value evaporated. Companies that had been worth billions went bankrupt. Let's look at some specific casualties. Pets.com, an online pet supply retailer, spent millions on Super Bowl ads featuring a sock puppet. They went from IPO to bankruptcy in 9 months. Webvan promised to deliver groceries in 30 minutes. They raised $800 million and built a massive infrastructure. They filed for bankruptcy in 2001, having burned through all of it. eToys was valued at over $8 billion at its peak. 2 years later, it was worth zero. Cosmo.com delivered snacks and DVDs in under an hour. Great service, terrible business model. They lost money on every delivery and went bankrupt. TheGlobe.com went public at $9 a share and closed the first day at 97. Biggest first day gain in history. The stock eventually fell to 10 cents. These weren't obscure companies. They were mainstream brands with massive visibility and seemingly smart people running them. And they all failed because the business models didn't work. They were selling products below cost to gain market share, assuming they could raise prices later. But customers had no loyalty. As soon as you stopped subsidizing their purchases, they left. There was no moat, no competitive advantage, no path to profitability. Investors who'd mortgaged their houses to buy these stocks lost everything. Warren Buffett's portfolio barely budged. He'd been proven right once again. Technology stocks were too speculative, too unpredictable, too risky. Real investors stuck with real businesses. This experience reinforced everything Buffett believed about investing. It validated his approach, and it blinded him to what came next, because while most dot-com companies failed, a few survived, and those few became the most valuable companies in history. Amazon went public in 1997 at $18 a share. It fell below $6 during the dot-com crash, bottoming out in 2001. Then it started climbing. Let's do the math on what Buffett missed. In 2002, Amazon stock was trading around $15 per share. Berkshire Hathaway had about $40 billion in investable assets at that time. If Buffett had invested just 1%, $400 million in Amazon at that price, he would have bought roughly 26.6 million shares at $15 each. Now here's where it gets interesting. Amazon executed a 20-for-1 stock split in June 2022. Those 26.6 million shares would have become 533 million shares after the split. Amazon currently trades around $170 per share. 533 million shares times $170 equals over $90 billion. From a $400 million investment, that's a 225-fold return. And that's using 2002 prices after the bubble burst, when Amazon had already proven it could survive. What if he'd bought at the IPO in 1997 at $18 per share? That same 400 million would have bought roughly 22 million shares. After the 20-for-1 split, that becomes 440 million shares, worth $75 billion today. What if he bought during the crash in 2001 when the stock hit $6? He could have bought over 66 million shares for $400 million. After the split, that's 1.3 billion shares, worth over $220 billion today. Any of these scenarios would have been the single greatest investment in Berkshire's history, bigger than Coca-Cola, bigger than Apple, bigger than anything. And we're only talking about 1% of Berkshire's capital. If he'd invested 5%, call it $2 billion in 2002 at $15 per share, he'd have bought 133 million shares. After the split, that's 2.6 billion shares, worth over $450 billion today, more than half of Berkshire's current total market cap from a single investment. But he didn't invest a single penny. He watched Amazon go from $20 billion in market cap in 2005 to over $1 trillion today, and never bought a share until 2019. By then it was too late to make that kind of return. The easy money, the 100-bagger opportunity was gone. Buffett watched this entire run and never bought a share. Google went public in 2004 at $85. After Google's 20 for one stock split in 2022, that's about $4.25 in today's split adjusted terms. The stock now trades around $170. That's an 80-fold return in 20 years, not the 30-fold you'd calculate if you ignored the split. Buffett didn't buy a share. Apple almost went bankrupt in the 1990s. Buffett didn't touch it until 2016, when it was already one of the most valuable companies in the world. If he'd bought Apple in 2000 when it was trading around $10 and invested even 5% of Berkshire's capital at that time, roughly $2 billion, that stake would be worth hundreds of billions today after accounting for Apple's multiple stock splits. He left astronomical sums on the table: Netflix, Facebook, Microsoft's resurgence under Satya Nadella starting in 2014. Buffett missed all of it. The cost of these missed opportunities is almost incalculable. If Berkshire Hathaway had put just 5% of its portfolio into Amazon, Google, and Apple in their early growth years, the company would be worth well over $1 trillion today instead of $700 billion. That's conservatively $300 to $400 billion in missed returns. And that's being extremely conservative with the calculations. The true opportunity cost when you account for all the stock splits and compounding could easily be $500 billion or more. But this isn't a story about a bad investor. Buffett is still one of the greatest investors ever. His returns over 60 years are extraordinary. This is a story about something more interesting: how the very principles that make you successful can become the chains that hold you back, how being right for so long can make it impossible to see when you're wrong, how wisdom can turn into dogma. Buffett's investment philosophy was built on a few core ideas developed over decades of experience. First, invest in businesses you understand. He called this staying within your circle of competence. If you don't understand how a company makes money, don't invest in it. This sounds simple, but it's profound. It prevents you from investing in things just because they're popular or because other people are making money. Second, look for companies with durable competitive advantages, what he called economic moats that protect them from competition. Coca-Cola has brand loyalty so powerful that people will pay a premium for it over generic cola. Railroads have physical infrastructure that competitors can't replicate. Banks have regulatory barriers to entry and customer switching costs. These moats ensure profits will continue for decades, even if management makes mistakes. Third, focus on companies with predictable cash flows. You should be able to reasonably estimate what the business will earn 5 or 10 years from now. This is crucial for valuation. If you can't predict future earnings, you can't calculate what the business is worth. Fourth, ignore short-term market fluctuations and hold forever. Buffett famously said his favorite holding period is forever. The stock market is a voting machine in the short term, but a weighing machine in the long term. Eventually, quality businesses get recognized and rewarded. Fifth, demand a margin of safety. Only buy when the price is significantly below your estimate of intrinsic value. This protects you if your analysis is wrong or if unexpected bad things happen. These 5 principles: circle of competence, economic moats, predictable cash flows, long-term holding, and margin of safety, guided every investment Buffett made for 60 years. And these principles worked incredibly well for physical world businesses. Let's use Coca-Cola in the 1980s as an example, because it was a perfect Buffett investment, and it illustrates why his framework failed with technology. Coca-Cola in 1988 when Buffett bought it. The product, carbonated sugar water, hadn't changed in a century. The formula was secret, but it didn't matter because the brand was what people bought. The business model was brilliantly simple. Coca-Cola manufactured syrup concentrate and sold it to bottlers. The bottlers mixed it with carbonated water, packaged it, and distributed it. Coca-Cola had very low capital requirements because the bottlers owned the expensive infrastructure. The competitive moat was enormous. Brand recognition was global. Distribution networks were entrenched. Even if Pepsi made a better tasting product, which was debatable, most consumers would still choose Coke because of brand loyalty and habit. Cash flows were incredibly predictable. You could look at Coca-Cola's financials from 1960 and 1970 and 1980 and see a straight line up. Earnings grew steadily year after year. There was no reason to think that would change. People would still be drinking Coke in 20 years, 30 years, 50 years. The valuation was straightforward: project future cash flows, discount them to present value, add a margin of safety. Buffett calculated that Coca-Cola was worth significantly more than its stock price, so he bought heavily, investing over $1 billion. Everything about this investment fit his framework perfectly. He understood the business completely. Any 10-year-old could understand Coca-Cola's business model. The competitive moat was clear and durable. The cash flows were predictable with high confidence. He could hold it forever because the business wasn't going to fundamentally change. And he got it at a reasonable price, though not necessarily cheap. It was the ideal Buffett investment, and it worked. That investment is now worth over $25 billion. Now let's contrast that with Amazon in 1997 when it went public. Amazon was an online bookstore. The product was books but delivered over the internet instead of in physical stores. The business model was to sell books below cost to gain market share, assuming economies of scale would eventually make them profitable. They had virtually no physical assets. Their competitive advantage, if any, was being first to market in online retail and having a website that worked well. Cash flows were not just unpredictable, they were negative. Amazon was losing money on every sale. They projected continued losses for years as they invested in growth. The valuation made no sense using traditional metrics. Price to earnings ratio was infinite because there were no earnings. Price to sales was very high compared to traditional retailers. Discounting future cash flows was impossible because nobody knew when or if Amazon would be profitable. Looking at this through Buffett's framework, Amazon failed every test. Did Buffett understand the business? Not really. Online retail was new. How do you compete when anyone can build a website? Where's the moat? Physical retailers had locations and inventory and relationships with suppliers. Amazon had a website. Were cash flows predictable? Absolutely not. Amazon might go bankrupt like most .com companies, or it might become profitable in 5 years or 10. Nobody knew. Could you hold it forever? How do you hold something forever when you can't predict if it will exist in 5 years? Was there a margin of safety? At what price is Amazon cheap when it has no earnings and no clear path to profitability? Buffett couldn't answer these questions, so he didn't invest. And according to his framework, that was the right decision. He stayed within his circle of competence. He avoided unpredictable businesses. He didn't buy what he didn't understand. By his own rules, he did everything correctly, but he was wrong. Amazon wasn't a traditional retailer that happened to sell online. It was a fundamentally different kind of business. The moat wasn't physical infrastructure. It was data, technology, and network effects. Every purchase on Amazon generated data about what customers wanted. That data made Amazon's recommendations better. Better recommendations meant more purchases. More purchases meant more data. This flywheel effect created a competitive advantage that got stronger over time. The more people used Amazon, the better it got. Physical retailers couldn't replicate this no matter how many stores they built. Amazon's willingness to lose money to gain market share wasn't reckless. It was strategic. Jeff Bezos understood that in a network effects business, the winner takes most of the market. Being profitable in year 3 doesn't matter if you're out of business by year 5 because a competitor got bigger faster. Amazon prioritized growth over profits. Once they achieved scale and market dominance, profits would follow. And that's exactly what happened. By 2005, Amazon had survived the .com crash and was clearly doing something different. It was expanding beyond books into electronics, home goods, everything. It was building a logistics network with warehouses and delivery capabilities that traditional retailers couldn't match. It was using data and technology to understand customers better than any company in history. It was launching Amazon Web Services, renting out its computing infrastructure to other companies, creating an entirely new high-margin business. And it still wasn't consistently profitable, but it was investing every dollar back into growth. Revenue was doubling every few years. The total addressable market, all of retail, was enormous. If Amazon could capture even 5% of global retail, they'd be worth hundreds of billions. This is where Buffett's framework failed him most clearly. He kept looking for traditional metrics: profitability, return on equity, free cash flow. Amazon didn't have those things. What it had was revenue growth and customer obsession and a vision for becoming the everything store. Buffett couldn't value that using his traditional methods, so he dismissed it. He later admitted he underestimated Jeff Bezos. He said Bezos accomplished something close to a business miracle. But even saying that, even recognizing how extraordinary Amazon's achievement was, Buffett still didn't invest until 2019 when Berkshire bought a small stake worth less than $1 billion. By then, Amazon was worth nearly $1 trillion. He'd missed the entire run. He'd watched Amazon go from a struggling online bookstore to one of the most valuable companies in history, and he never got on board because it didn't fit his framework. And here's the thing, his reasoning wasn't crazy. Most online retailers from that era did fail. Pets.com, Webvan, eToys, hundreds of others. They burned through billions in venture capital and went bankrupt. Buffett was right to be skeptical. The problem was he stayed skeptical even as the evidence changed. Even as Amazon proved it wasn't just an online bookstore, but a completely new kind of company. By 2005, Amazon had survived the dot-com crash and was clearly doing something different. It was expanding beyond books into electronics, home goods, everything. It was building a logistics network that traditional retailers couldn't match. It was using data and technology to understand customers better than any company in history. And it still wasn't profitable, but it was investing every dollar back into growth. This is where Buffett's framework failed him. He kept looking for traditional metrics, profitability, return on equity, free cash flow. Amazon didn't have those things. What it had was revenue growth and customer obsession, and a vision for becoming the everything store. Buffett couldn't value that using his traditional methods, so he dismissed it. He later admitted he underestimated Jeff Bezos. He said Bezos accomplished something close to a business miracle. But even saying that, even recognizing how extraordinary Amazon's achievement was, Buffett still didn't invest until 2019, when Berkshire bought a small stake worth less than $1 billion. By then, Amazon was worth nearly $1 trillion. He'd missed the entire run. The same pattern repeated with Google. Google went public in 2004 with a clear dominant position in search advertising. It had over 70% market share. It was printing money. Advertising revenue was growing exponentially. But Buffett didn't invest. Why? Because he didn't understand the technology. He couldn't predict whether Google's search dominance would last. What if Microsoft or Yahoo built a better search engine? What if users switched? He needed certainty, and he couldn't find it in a technology platform, so he sat out. And Google went from an $80 billion company to a $2 trillion company, and Buffett missed all of it. With Apple, the story is slightly different and even more revealing. Apple nearly went bankrupt in 1997. Steve Jobs returned as CEO and turned the company around with the iMac, then the iPod, then the iPhone. By 2010, Apple was the most valuable technology company in the world. The iPhone had created a completely new market. Apple's ecosystem of hardware, software, and services created incredible customer loyalty. People who bought iPhones bought iPads and MacBooks and AirPods. They subscribed to iCloud and Apple Music. It was a recurring revenue goldmine with profit margins most companies could only dream of, and it was obvious. Everyone could see it, except Warren Buffett. He finally started buying Apple stock in 2016, not 2007 when the iPhone launched, not 2010 when the iPad came out. 2016, nearly 10 years into the iPhone era, when Apple was already trading at a $600 billion valuation. Why did he finally buy? Because by 2016, Apple looked less like a technology company and more like a consumer products company. It had the predictable cash flows Buffett wanted. It had a moat in the form of ecosystem lock-in. It had brand loyalty rivaling Coca-Cola. In other words, he bought Apple when it started to resemble the kind of companies he'd always invested in. He didn't buy it as a bet on future innovation. He bought it as a bet on the existing business continuing. And even that decision took him years to make. He admitted his partner Charlie Munger had been pushing him to buy Apple earlier, and he'd resisted. That Apple investment became one of Berkshire's most successful ever. They put about $30 billion into it starting in 2016, and it's now worth over $150 billion. A 400% return in 7 years, which just makes the earlier missed opportunity more painful. If Buffett had invested just 5% of Berkshire's capital in Apple back in 2000 when the entire company was valued at only around $15 billion, he could have bought a massive stake for roughly $2 billion. Apple's market cap is now over $3 trillion. That $2 billion stake would be worth hundreds of billions today. He left astronomical amounts on the table by waiting 16 years. So what was the actual mistake here? It's easy to say Buffett should have invested in technology companies, but that's too simple. Lots of smart investors bought technology stocks and lost money. Lots of tech companies failed. The mistake was more subtle. Buffett built a mental model based on his experience with physical world businesses, and he couldn't update that model even when the world changed. He saw investing as finding undervalued assets with predictable futures. But technology companies aren't about undervalued assets. They're about option value and network effects and platform dynamics. They're about betting on exponential growth even when current metrics look terrible. Amazon was never undervalued in the traditional sense. It usually traded at a huge multiple to earnings because it reinvested everything into growth. But it was still a great investment because the growth was real and sustainable. Buffett's framework had no way to evaluate that. He needed to see profits now, not promises of profits later. He needed predictability, and technology is fundamentally unpredictable, which is why he avoided the entire sector for decades. But here's the irony. If you actually understood the businesses, if you spent time studying how Amazon's flywheel worked, or how Google's advertising auction system created a sustainable moat, these companies were less risky than Buffett thought. Amazon's competitive advantage was more durable than most traditional retailers because it was based on infrastructure and data, things that compound over time. Google's search dominance was more secure than newspaper advertising because of network effects. Every search made Google better, which brought more users, which brought more advertisers, which funded more innovation. These were moats, just different kinds than Buffett was used to seeing. Charlie Munger, Buffett's longtime business partner, understood this. Earlier, he pushed Buffett to buy Google. He argued that Google's search dominance was obvious and durable. Buffett listened but didn't act. Why? Probably because he'd been burned by technology before. He'd bought into IBM in 2011, one of his few forays into tech. He invested about $10 billion over several years, building a position of over 80 million shares. His thesis was that IBM had a strong position in enterprise computing with long-term client relationships and recurring revenue from software and services. He thought IBM would benefit from the shift to cloud computing and big data analytics. On paper, it made sense. IBM had a 100-year history. It had strong relationships with Fortune 500 companies. It had a reputation for reliability, but Buffett fundamentally misunderstood where enterprise technology was heading. IBM's traditional business was selling expensive hardware and software to large corporations with multi-year service contracts. Their customers were locked in because switching costs were high. That lock-in was the moat Buffett saw. But the technology world was shifting to cloud computing, where companies could rent computing power and software as a service instead of buying IBM's expensive hardware. Amazon Web Services, Microsoft Azure, and Google Cloud were eating IBM's lunch. They offered better technology at lower prices with more flexibility. IBM tried to compete, but they were too slow, too bureaucratic, too committed to their legacy business model. Buffett held the IBM position for 6 years, watching it slowly decline. The stock went nowhere while the market soared. Amazon's cloud business AWS went from nothing to a $40 billion a year revenue machine, while Buffett owned IBM instead. Microsoft under Satya Nadella pivoted to cloud and the stock tripled. Google invested heavily in cloud infrastructure, and IBM, despite spending billions on acquisitions and research, fell further and further behind. Buffett finally admitted defeat in 2017 and started selling. He got out completely by 2018. Final tally, he put in roughly $10 billion, got back around $9 billion, a loss of about $1 billion, not counting opportunity costs, but the real loss was bigger. If he put that same $10 billion into Amazon in 2011 when he was buying IBM, it would be worth over $400 billion today. That's not hindsight bias. Amazon was obviously winning in cloud computing by 2011. AWS was already a multi-billion-dollar business growing at 50% a year. Buffett chose IBM, the old incumbent, over Amazon, the disruptor, and he lost. It reinforced his skepticism about technology, but that's the wrong lesson to draw. The lesson shouldn't be avoid technology. The lesson should be understand what you're buying. Buffett didn't really understand IBM's business. He invested based on reputation and brand, classic Buffett factors, but he missed that the technology landscape had shifted. Meanwhile, he refused to invest in Amazon, which he actually did understand, at least conceptually. He knew Jeff Bezos was brilliant. He knew Amazon was taking market share. He knew the logistics network was a real moat. But he couldn't get past the lack of current profits. He let his framework override his judgment. But that's the wrong lesson to draw. The lesson shouldn't be avoid technology. The lesson should be understand what you're buying. Buffett didn't really understand IBM's business. He invested based on reputation and brand, classic Buffett factors, but he missed that the technology landscape had shifted. Meanwhile, he refused to invest in Amazon, which he actually did understand at least conceptually. He knew Jeff Bezos was brilliant. He knew Amazon was taking market share. He knew the logistics network was a real moat, but he couldn't get past the lack of current profits. He let his framework override his judgment. This is a trap that catches a lot of successful people. They develop a system that works. That system becomes their identity. Warren Buffett is the value investor who buys boring businesses and holds forever. That's his brand. That's what shareholders expect. That's what he's built a 60-year reputation on. Changing that system feels like betraying who you are. Even when the evidence suggests you should change, the psychological cost is too high. Buffett couldn't buy Amazon without admitting that his entire framework might need updating, so he didn't buy. Compare this to how Jeff Bezos thinks about investing in Amazon itself. Bezos doesn't demand current profitability. He invests in projects that might not pay off for 10 years. Amazon Web Services lost money for years before becoming the most profitable part of the company. The Kindle lost money initially. Amazon Prime lost money initially. Bezos was willing to sacrifice short-term earnings for long-term market position. This is the opposite of Buffett's approach. Buffett wants to see the earnings now and trust they'll continue. Bezos wants to invest now and trust the earnings will come later. Both can work, but they're fundamentally different philosophies. And here's what makes this even more interesting. Buffett has actually praised Bezos repeatedly. In interviews, he's called Bezos one of the greatest business minds of our time. He's marveled at Amazon's execution. He understands intellectually why Amazon is a great company, but he still didn't invest. Why? Because understanding something intellectually is different from trusting it enough to bet billions on it. Buffett's investment philosophy requires conviction based on historical patterns. Amazon had no historical pattern. It was creating a new category. To invest in it, you had to believe the future would be different from the past. Buffett's entire career was based on believing the future would be similar to the past. This is the core tension. The opportunity cost number of around $50 billion often cited is actually conservative and doesn't account for stock splits correctly. If you add up all the technology investments Buffett could have made and didn't, properly accounting for Amazon's 20-for-1 split in 2022 and Google's 20-for-1 split the same year, the opportunity cost is closer to $500 billion or more. Just Amazon alone, if he'd invested 1% in 2002, would be worth over $90 billion today. But focusing on the exact number misses the point. The point is that Buffett's mistake wasn't about missing one stock or even one sector. It was about failing to recognize when the world had fundamentally changed. For most of Buffett's career, the dominant companies were industrial and consumer goods firms. Coca-Cola, Gillette, Wells Fargo, American Express. These companies had moats based on physical distribution, brand recognition, and regulatory barriers. Technology changes slowly in those industries. Coca-Cola's product is the same as it was 50 years ago, but in technology, dominant companies can be disrupted in 5 years. Google disrupted Yahoo, Facebook disrupted MySpace, Netflix disrupted Blockbuster. The pace of change is exponentially faster. Buffett's framework assumes change is slow and predictable. It's optimized for stability, but technology is about instability, creative destruction, constant evolution. You can't evaluate tech companies the same way you evaluate railroads, and Buffett never fully made that mental shift. He kept trying to fit technology companies into his existing framework. When they didn't fit, he assumed they were uninvestable. He didn't consider that maybe his framework needed updating. This is particularly striking because Buffett is famous for saying, "When the facts change, I change my mind." He's supposed to be adaptable, willing to admit mistakes, constantly learning, and in many ways he is. He's updated his views on airline stocks, on gold, on cryptocurrency, but on technology he held on to his skepticism for decades, even as the evidence mounted. Why? Probably because technology required not just changing his mind on one issue, but questioning his entire investment philosophy. That's a much harder thing to do, especially when that philosophy has made you one of the richest people in history. There's also an element of pride. Buffett built his reputation on being different from Wall Street. While traders were chasing hot stocks and complex derivatives, Buffett was buying boring businesses and holding them. He was the anti-Wall Street figure, the folksy guy from Nebraska who proved you didn't need fancy algorithms or insider information, you just needed common sense. But admitting he should have bought Amazon or Google would mean admitting that sometimes the hot stock everyone is excited about actually is a good investment. It would mean the market was right and he was wrong. That's a hard pill to swallow. Buffett eventually came around, at least partially. In 2016, he started buying Apple aggressively. In 2019, Berkshire bought Amazon stock, though only about $1 billion worth, a tiny position for a company with hundreds of billions to invest. He's acknowledged his mistakes publicly. At the 2017 shareholder meeting, he said we were too dumb to realize what was going to happen with Google. At the 2018 meeting, he said I made the wrong call on Amazon multiple times, but these admissions came only after the opportunities had mostly passed. He was right but too late, which in investing is the same as being wrong. The lessons from this are fascinating because they apply beyond investing. First, the strategies that make you successful in one era can become liabilities in the next. Buffett's value investing approach was perfect for the industrial economy. It's less suited for the information economy. Recognizing when your strengths have become weaknesses is incredibly difficult but essential. Second, conviction based on past patterns can blind you to new realities. Buffett was so convinced by his experience with the dot-com bubble that he couldn't see how the survivors were different. He kept fighting the last war. Third, being right once doesn't mean you'll be right forever. Buffett was right about avoiding most technology stocks in the 1990s, but he took that as validation that he should always avoid technology stocks. He overlearned the lesson. Fourth, even the smartest people have blind spots. Buffett is arguably a genius at analyzing businesses, but he's admitted he doesn't understand technology deeply. Instead of compensating for that blind spot by bringing in people who do understand it, he just avoided the sector entirely. That's a costly mistake. Fifth, ego and identity can trap you. Buffett's identity as a value investor made it psychologically difficult to invest in growth stocks even when the growth was obviously sustainable. But perhaps the most important lesson is this: the market rewards being right about the future, not the past. Buffett spent decades being right about which established businesses would continue thriving. He got rich betting on Coca-Cola and See's Candies and Nebraska Furniture Mart. But the truly massive wealth creation in the last 20 years happened in companies that were building the future. Amazon, Google, Apple, Microsoft, Facebook, Netflix. These companies created trillions in shareholder value by imagining new possibilities and executing on them. Buffett didn't participate in most of that because he couldn't predict it with certainty, and his framework demanded certainty. This raises an uncomfortable question. If Warren Buffett, arguably the greatest investor ever, with unlimited resources and 60 years of experience, can make mistakes worth hundreds of billions of dollars by sticking to principles that had always worked before, what does that mean for the rest of us? How do we know when to stick to our principles and when to question them? How do we avoid Buffett's mistake without abandoning the discipline that made him successful in the first place? These aren't easy questions. There's no formula, but there are clues. One is to distinguish between principles and tactics. Buffett's principles: invest in great businesses at fair prices, understand what you own, think long term. Those are still valid. But his tactics: avoid technology because it's unpredictable, only buy companies with current profits. Those were tactics suited to a particular era. Principles should be stable, tactics should evolve. Buffett conflated the two. He treated his tactics as if they were universal principles. Second clue is to actively seek out people who disagree with you. Charlie Munger kept telling Buffett to buy Google. Buffett listened but didn't act. If he'd actually engaged with Munger's arguments, really tried to understand why Munger was convinced, he might have changed his mind earlier. Instead, he nodded politely and stuck to his views. Third clue is to separate your ego from your portfolio. This is hard because we tend to identify with our beliefs. If you've spent 50 years saying technology stocks are too risky, admitting you were wrong feels like admitting your entire career was based on a mistake. But actually, you can be right for 50 years and then wrong for the next 10 because the world changed. That's not a failure of judgment, that's the nature of reality. Things change. Buffett eventually accepted this, but it took him way too long. Fourth clue is to look for asymmetric opportunities. Even if Buffett thought Amazon was risky, the risk reward was incredibly skewed. If Amazon failed, he'd lose his investment. If it succeeded, it could be worth 50 or 100 times his investment. Those odds are worth taking even with uncertainty. Buffett understood this concept. He'd written about margin of safety and asymmetric bets, but he didn't apply it to technology. Fifth clue is to question your assumptions regularly. Buffett assumed technology was unpredictable and therefore uninvestable. But was that actually true? Or was it that he hadn't spent enough time understanding how technology businesses work? If he'd studied Amazon's flywheel effect or Google's network advantages as deeply as he studied Coca-Cola's distribution system, would he have seen the predictability he was looking for? Maybe, but he never did the work because he'd already decided technology wasn't in his circle of competence. He created a self-fulfilling prophecy. There's also a broader point about innovation and disruption. Buffett got rich investing in companies that had already won. Coca-Cola was already the dominant soft drink when he bought it. American Express was already the leading credit card. Wells Fargo was already a major bank. He was betting on continued dominance, not on disruption. That worked because these companies had structural moats that protected them from competitors, but technology doesn't respect structural moats the same way. Google disrupted entire industries, Amazon disrupted retail, Facebook disrupted media. These companies didn't just win in their existing markets, they created new markets. And betting on that kind of disruption requires a different mindset. Buffett's mindset was fundamentally conservative. He wanted to preserve capital and earn steady returns. Nothing wrong with that. It made him incredibly wealthy, but it meant he missed the most explosive wealth creation of the modern era. The question is whether he cares. And the answer seems to be yes and no. Yes, he regrets missing Amazon and Google. He said so publicly. He recognizes the missed opportunity, but no, he hasn't fundamentally changed his approach. Berkshire is still primarily invested in traditional businesses, banks, insurance, railroads, energy. The Apple investment is the exception, not the rule, and even that was framed as a consumer products investment, not a technology bet. This gets at something deeper about human nature and success. Once you've achieved massive success doing things a certain way, it's almost impossible to completely change your approach. Psychologically, financially, practically, you're locked in. Buffett could have tried to become a technology investor in 2005. He had the capital. He had the platform. But it would have meant abandoning everything that made him Warren Buffett. It would have meant competing with venture capitalists and growth investors who understood technology far better than he did. It would have meant risking his reputation on a sector he didn't fully understand. The downside risk, not financial but reputational, was too high, so he stuck with what he knew. And you know what? He's still done fine. Berkshire Hathaway is worth $700 billion. Buffett is worth over $100 billion personally. He's 93 years old and still running the company. He didn't need to invest in Amazon to be successful. He was already successful. Missing these technology investments only looks like a mistake in comparison to what could have been. In absolute terms, Buffett's strategy still worked incredibly well. Maybe that's the real lesson. You don't have to be perfect. You don't have to catch every opportunity. You just have to be right enough, often enough to succeed. Buffett was right enough to become one of the richest people in history. Missing Amazon doesn't change that, but it does raise questions about how we measure success. Is success about absolute returns or relative returns? Buffett beat the market for 60 years, that's extraordinary, but he also missed the biggest wealth creation in modern history. Does that diminish his achievement? Or is it just an asterisk on an otherwise perfect record? There's no right answer. It depends on your perspective. From one angle, Buffett's miss of Amazon is a cautionary tale about the dangers of rigid thinking. From another angle, it's proof that even missing some opportunities doesn't prevent massive success if you get enough other things right. What's undeniable is that the world changed and Buffett didn't fully change with it. The companies that dominate the stock market today look nothing like the companies that dominated when Buffett started investing. In 1965, when he took control of Berkshire Hathaway, the most valuable companies were AT&T, General Motors, Exxon, General Electric, all industrial giants. Today, the most valuable companies are Apple, Microsoft, Google, Amazon, Facebook, all technology platforms. That's not a coincidence. It's a fundamental shift in how value is created. Value used to come from physical assets and distribution networks. Now it comes from data, software, and network effects. Buffett understood the old model perfectly. He never fully grasped the new one. And maybe that's okay. Maybe it's unrealistic to expect someone in their 80s and 90s to fully understand smartphone apps and cloud computing and artificial intelligence. Maybe the real mistake was Berkshire not developing a succession plan that included people who did understand technology. Buffett has talked about this. He's acknowledged that Berkshire needs to evolve after he's gone, but the company still reflects his philosophy, his biases, his blind spots. It's built in his image. When he's no longer around, will Berkshire be able to adapt? Or will it become a fossil, powerful but obsolete, like the railroad companies Buffett invested in? That's the cliffhanger. Warren Buffett made mistakes worth hundreds of billions of dollars by missing the technology revolution, but Berkshire Hathaway might be making an even bigger mistake right now, because the next revolution, artificial intelligence, is happening as we speak, and Berkshire isn't a major player. The company has no significant AI investments, no partnerships with OpenAI or Google DeepMind or Anthropic, no big bets on autonomous vehicles or robotics or biotech powered by machine learning. Buffett has said he doesn't understand AI, so he won't invest, which is the exact same reasoning that caused him to miss Amazon 25 years ago. Think about what that means. In 1997, Buffett said he didn't understand internet commerce, so he wouldn't invest in Amazon. In 2004, he said he didn't understand search advertising, so he wouldn't invest in Google. In 2007, he said he didn't understand smartphones, so he didn't invest in Apple until 2016. Now, in 2024, he says he doesn't understand artificial intelligence, so he won't invest in AI companies. The pattern is identical, and each time the opportunity he missed was bigger than the last. Missing Amazon cost him over $90 billion in potential returns from just a small position. Missing Google cost him similar amounts when you account for the stock split. Missing the early years of Apple cost him astronomical sums. How much will missing AI cost? Consider the numbers. OpenAI, the company behind ChatGPT, is valued at over $80 billion and growing fast. Nvidia, which makes the chips that power AI, has gone from a $200 billion company to over $3 trillion in market cap in just 3 years. Microsoft has integrated AI across its entire product line, and the stock has tripled. Google is investing tens of billions in AI research and infrastructure. Even traditional companies are racing to adopt AI. The total market opportunity for AI is estimated in the tens of trillions of dollars over the next decade. And Berkshire Hathaway is sitting on the sidelines with over $150 billion in cash, earning 5% in treasury bills. That's safe, that's predictable, that's exactly what Buffett did with technology stocks for 20 years while missing the greatest wealth creation in history. Is Berkshire repeating the same mistake in real time? And if Warren Buffett, the greatest investor in history, couldn't overcome his blind spots even after recognizing them, what chance does anyone else have? He admitted publicly that he was wrong about Amazon. He said he underestimated Jeff Bezos. He acknowledged missing Google was a mistake. And yet, faced with the next technological shift, he's making the same decision, staying in his circle of competence, avoiding what he doesn't understand, sticking to his principles. Is that wisdom or stubbornness? Is it discipline or dogma? The honest answer is nobody knows yet. Maybe AI will be like the dot-com bubble. Lots of hype, lots of money lost, a few winners but mostly failures. In that case, Buffett will be proven right again. Or maybe AI will be like the internet itself, transformative, unstoppable, creating trillions in value for companies that figure it out early. In that case, Buffett is missing it again. But here's what makes this different. Buffett is 93 years old. He won't be around to see how the AI revolution plays out over the next 20 or 30 years. The question isn't whether he'll admit he was wrong about AI in 2040. The question is whether Berkshire Hathaway as an institution can evolve after he's gone. Can it develop new frameworks for evaluating technology companies? Can it bring in investment managers who understand AI and quantum computing and synthetic biology? Or will it remain frozen in the value investing paradigm that worked so well in the 20th century but struggled in the 21st? Buffett has talked about succession planning. He's identified 2 investment managers, Todd Combs and Ted Weschler, who will help manage Berkshire's portfolio after he's gone. But they're both value investors trained in the Buffett school. They think like he thinks. They have the same biases. Will they be able to see opportunities he couldn't? Or is the lesson that you don't need to catch every wave to be successful? That sometimes missing opportunities is the price of sticking to your principles? Buffett's net worth is over $100 billion. Berkshire Hathaway is worth $700 billion. The company generates over $30 billion in annual profit. By any objective measure, Buffett succeeded wildly even while missing the biggest investment opportunities of the modern era. Maybe that's okay. Maybe you don't need to be perfect. Maybe being right enough, often enough is sufficient. Maybe the real mistake would have been abandoning his principles to chase technology stocks he didn't understand. Maybe he would have lost money on them like he did with IBM. Maybe his shareholders are better off that he stuck to what he knew. But that's a rationalization and Buffett knows it. He's admitted it publicly. The opportunities were real. The returns were real. He missed them not because he lacked information, but because he couldn't update his mental model. And that cost his shareholders hundreds of billions in potential returns. Can you call that success when you left so much on the table? Or is success measured in absolute terms, not relative terms? Buffett is still one of the richest people who ever lived. Does it matter that he could have been twice as rich if he'd bought Amazon? These are philosophical questions without clear answers. What's clear is that the world changed and Buffett didn't fully change with it. The companies that dominate the stock market today look nothing like the companies that dominated when Buffett started investing. And here's the final question, the one that keeps you up at night if you think about it too deeply. If wisdom and experience and intelligence aren't enough to overcome blind spots, what is? Buffett had all 3 in abundance. He's one of the smartest people in business. He has more investing experience than almost anyone alive. He's known for his wisdom, his clear thinking, his ability to cut through complexity and see what matters, and yet he missed Amazon, Google, Facebook, Netflix, and the entire technology revolution. If he couldn't see it, How are the rest of us supposed to see the next big thing? How do we know when we're being disciplined and when we're being stubborn? How do we distinguish between wisdom and outdated thinking? Because in the end, that's the $100 billion question, and nobody, not even Warren Buffett, has figured out the answer.